Hello, Matthew Bell with InsurancePrescription.com. Today I wanted to talk about different ways of using your personal retirement assets. Obviously, you can use your retirement assets. There's any number of ways to think about how to use your retirement assets. I mean, you could just cash your retirement account out and blow it at the casino. That's not what I'm talking about here. What I'm talking about is different ways of using the retirement assets that you've accumulated in retirement. And primarily what I have in mind here is to try and leverage those assets into an income stream in some respect, because ultimately a number of financial planners and experts, which I am not, are going to say that your retirement is going to be more about your income than your assets. And the reason for this is that the assets don't do you any good just sitting off to the side. You need them in order to pay for certain expenses, whether it's a mortgage payment. Maybe you've paid off your mortgage, but you're still probably going to have property taxes, utility bills, insurance costs, grocery bills. There are ongoing income needs that you're going to have. And if you have only an asset, you're going to have to find some way of using that asset to pay for those income needs. Now, a couple of things just as a preface. So obviously there are a number of different retirement vehicles. You have employer-sponsored plans like the 401k, 403b, 457b. I've got separate videos on each of those. You've got personal individual retirement accounts, whether they are traditional IRAs, Roth IRAs. You have retirement accounts that you can set up yourself. You have CDs and money markets, and you have brokerage funds, and you have all different kinds of things, savings accounts. You have all different kinds of funds and all kinds of vehicles that we might be talking about in terms of vehicles that you're using to accumulate money for your retirement. But for the time being, I'm going to skip over all of the niceties about the differences of those vehicles, and I just want to talk about concepts of how to use the cash wherever it is. So in doing that and framing the conversation this way, it has its pluses and its minuses. It's obviously relevant what kind of a vehicle you have it in, because it's going to affect the tax status of the money. It's going to affect the rate of return that you can expect to get. So there are certainly things about the different vehicles that are highly relevant to a conversation about retirement in general. But the reason I want to ignore it presently is because all I want to focus your attention on is, supposing you have some block of cash, $100,000, $500,000, $1 million, 1.5, $2 million, whatever it happens to be. You've got a block of cash. The question is going to be the same no matter what the size of that block of cash is. How do I use it in retirement? Particularly, how do I generate income from that block of cash? Whatever it is, whatever vehicle it's at, after I pay tax of whatever rate, whatever bracket, whatever rate of return I got, how do I use that asset? And I'm going to present four main ways. I'm really turning up the volume here on a conversation that I started to have in another video, and in that video was called 7 Different Conceptions of Retirement. I'll put the link in the description. In that video, I get into this a little bit, but I'm going to kind of, again, turn the volume up and kind of focus in on this to make sure I kind of sharpen up the contours of that question. So the first way that you can use a retirement asset is as a pile of cash. You can treat it just like it's a piggy bank, essentially. And to some people, this is a naive view, and I'm not disagreeing, but there are people who have this conception. My mom, for example, has this conception about her retirement assets, is that they're like a big piggy bank and she can just pull money out. Now, there are a number of facets of this. There are certain psychological aspects to this, possibly where a person might think of an account. So let's say they have $100,000 in an account. Well, $100,000 is a lot of money for a piggy bank, but it's not a lot of money for a retirement account. And so if you have a piggy bank conception, not only is it going to inform the way you're going to think about using the asset, but it's also going to color your opinion of how big the asset is and how much it's able to do for you in retirement. On this conception, the pile of cash conception, the idea of your asset being used for income is simply going to be you're going to draw it down. If you needed money in your piggy bank, you just reach in and grab some, or you dump some of it out onto the floor and you use it, and the rest of it stays in the piggy bank until you need it the next time. Now, there are a couple of pluses, I suppose, that you can think of with this kind of conception. First, it seems like you've got control over the asset because you can handle it, you can keep it in your house if you want to. Not that I'm advising any of this, mind you. You would risk losing your assets in a house fire, and this is very sort of toy example here, because in most cases, people who have a piggy bank conception or a pile of money conception are still going to have their asset in a savings account or in a CD or in a money market. But you might think it's isolated from market risk because most of the vehicles you're going to keep your money in on this conception are going to be fairly well insulated from market risk. Now, that doesn't mean there's no risk at all. They may have institutional risk, savings and loans, banks fail. So if you have your money in a bank, it's not immune from risk, or even if it's disconnected from the market. The person who has the conception of a pile of money is thinking of a retirement account almost like an emergency account. You put an emergency fund together primarily for accessibility, for liquidity. You don't necessarily put the emergency fund money into a brokerage account because the main objective of the emergency fund is to get it quickly when you need it, not to get the highest rate of return that you can. So another consequence of thinking of your cash as a pile of money in retirement is that you're inclined to put it into some kind of a very conservative vehicle. Now, that might be justifiable or not justifiable. There are certain metrics like the law of hundreds, and I get into that in a separate video, where you can think of your age as a percent of how much of your assets should be out of the market. So for instance, if you're 70, it's arguable that the majority of your money ought to be disconnected from market risk. You can have too much of a good thing, and you can have money that is too risky, and you can also have money that is too conservative. If you have an adequate income stream elsewhere, so for example, suppose you have Social Security, a pension, you've got plenty of income coming from other sources, and literally this nest egg is just going to sit there. It then almost does become something like an emergency fund, and this conception might actually work if you have the ability to generate an income stream from some other place. But there are a number of negatives here, and the first negative is going to be you need a lot of cash in order to meaningfully generate the kind of withdrawals you'd need to have in order to pay ongoing expenses like grocery bills, like utility costs. If you have $1 million and you needed to live on $50,000, then you would have 20 years to draw money out of that $1 million piggy bank before you ran out of cash. So this conception really isn't ideal if you need the money to live on. If it's simply extra, then that's one thing, but you should bear in mind that there is also a negative in respect of that as well, and that would be that in legacy and estate planning, if you're not touching the money while you're alive, then it's likely that some or all of it's going to pass on to a beneficiary. And if it's a non-spousal beneficiary, there can be severe tax consequences by having your money in certain vehicles. So there are ways of optimizing the transference of that asset to the next generation, but you're going to have to look at that, and you're actually going to have to plan for it. Now, the second conception of using your assets is going to be what I've termed elsewhere the interest machine. Now, this is the conception that a lot of money managers are going to have, people who deal with mutual funds and investments, because what they're essentially thinking of is you take your money and you put it into an account, not so that it can sit there and you can draw off of it. It's so it can sit there and generate a rate of return, which then you draw the money that it has returned and you live on that instead. So for instance, if you have $1 million in an account that's earning you 5% rate of return, then that is $50,000 a year in return that you're getting every year on $1 million. So the conception that these people have typically is if you have $1 million generating 5%, you don't need to touch the million. You can simply draw off the amount of interest that it's earning, the yield that it's producing, the return that it's generating. You can live off that return indefinitely, asterisk. So in this conception, you conserve your principal. That is to say, you don't touch the principal, you're simply living off the interest, so that's a positive. The more money you have in terms of the asset, the better this conception works, because the more wiggle room you have. And here's what I mean. If you only need $50,000 a year, you could generate $50,000 a year with $500,000 on the same interest machine conception. But in order to do that, you'd need to get a 10% rate of return, which is less likely than getting a 5% rate of return. So if you had $1 million, you could do $50,000 with a 5% rate of return. But if you had $2 million, you could actually generate the same $50,000 with a 2.5% rate of return instead. And now here's the point. The more money you have, the less you have to rely on market returns to make up the shortfall, and the more you can allow for a margin of error. Because the reality is, even if the S&P does return an average of 10% per year, it's an average rate of return, meaning that if you add up the returns over a 10-year, 20-year, 30-year period and then divide by 10, 20, or 30 years, you'll get an average rate that comes out to about 10%. But that doesn't mean that each and every year you're going to get 10%. So in some years you're going to get more, and in some years you're going to get less. And in years where you get less, you're going to start potentially having to tap into your principal. And if you tap into your principal, then the same rate of return that you are assuming is not going to generate the amount of money that you need. So in other words, if you have $1 million at 5%, that gives you 50,000. But as soon as you have to tap into that principal, as soon as there's 1 year where you have to take the balance from $1 million down even just a little bit, let's say you have to take it down to 975,000. Well, every year after that then that you do get a 5% rate of return, you've got to realize that 5% of 975,000 is no longer $50,000. It's going to be a little less. And every year you have to draw your principal down means you're committed to pulling out the difference from the principal in order just to make your ends meet. So a negative, obviously, in this approach is that it can be difficult to calibrate things correctly. It's difficult to find a vehicle that is both conservative enough so that you in retirement feel comfortable with it, but is also generating the kind of return that you're going to need in order to get a meaningful income stream from it. And again, negative market returns are going to impact you, and they're going to do more damage to you if you're living off the money than they would if you weren't living off the money. So if you're not touching your money, a negative market return, yeah, it sucks, but you can still make it up the next year. But if you're living on the money, then you've got nowhere to go but to the principal if the actual rate of return doesn't generate the amount that you need to live on. There's another concern in the vicinity. It's called sequence of returns risk. I've done another video on that. Not going to get into that here. And the final negative on this conception is that there can also be challenges for legacy planning. So let's just even imagine that the plan goes off perfectly. You have a vehicle with $1 million in it, you're making a 5% rate of return every single year like clockwork, and then when you die, let's say you leave $1 million on to your beneficiary. Well, if it's a non-spousal beneficiary, then there's going to be a considerable tax bill that comes due. So even if the plan works perfectly, you're going to end up with a legacy or estate planning problem because $1 million left in most accounts like a 401k and IRA are going to create a sizable tax burden for your beneficiary in a non-spousal beneficiary situation. Now, the third conception would be to buy yourself some kind of an income in this regard. So let's say you buy rental properties and now you're living off the rental income. Let's say you buy dividend-paying stocks and now you're living off the dividend. Now, this can be a very attractive option as well because, number one, you conserve your principal. You actually keep the principal. In the case of a dividend-paying stock, it's simply in the stock. In the case of the rental properties, it's in the rental properties. Now, a couple of negatives. Rental properties, obviously, they're going to require maintenance and upkeep. You're probably going to have to hire a property manager because as you age, I would imagine you're going to be less able to deal with the various administrative tasks. You might even be less willing to even try. There is going to be somewhat of a question about the properties holding their value, but in a similar way, dividend-paying stocks can go up, down. The dividend might be reassessed and recalculated, and it might go up or down. So there are lots of questions regarding the use of the money in this way, but it can work for some people. Dividends aren't guaranteed, of course, and to the extent to which you're still connected to the market, there are attendant risks, as we just discussed in the previous example. Now, the fourth conception is also a variation of buying an income stream, but it's a little bit different. Instead of rental properties or dividend-paying stocks, on this conception, you buy an annuity. And this way of using an annuity, there's a number of different ways of using an annuity. You can use an annuity just like it was some kind of a savings account, if you want to think of it that way. You could just put money into it and never annuitize it, never settle it. But what I have in mind is actually trading an asset for an income stream. So in other words, buying an annuity, perhaps it's an immediate annuity where you simply take $1 million and you say, okay, what is the amount of money? So let's say you give the insurance company $1 million and they guarantee you $50,000 a year for the rest of your life. Well, unlike the pile of money conception, this is not a simple division problem of 1 million divided by 50,000 means that annuity is going to be 20 years. They're going to give you that annuity, on my example, for the rest of your life. So if you live 25 years, you're going to end up with more than $1 million that you got out of it. If you live 15 years, you might get less, but there are certain options you can elect for survivorship in order to try and guarantee continuing payments onto somebody else. Now, the annuity is often going to be the option that gives you the most bang for your buck, but you are giving up the principal. So you're exchanging your asset. You're exchanging the $1 million for a promise to pay from the insurance company. There's institutional risk. There are insurers that may default or that may not have the money to come up with the payment or might have to reduce your payment. There's a number of things that can go wrong. But if you pick a strong company there can be a lot of peace of mind with respect to an annuity because it essentially is going to guarantee you a paycheck for the rest of your life. It's like buying a pension for yourself. All of these different options, from pile of money, interest machine, generating income through real estate, dividend-paying stocks, or the purchase of an annuity, all of them are going to have attendant risks. And some of the things that we're ignoring about each of these are going to be things like, how do you deal with cost of living increases, inflation? There are perhaps increases in terms of expenses, maybe in terms of emergencies, unpredictable or even predictable emergency situations. Like, for example, it's predictable that your healthcare coverage is going to go up. It's predictable that you may need long-term care assistance. And all of these things that we've discussed so far are different ways of using cash that you've already accumulated, but you're also going to want to give some thought to what's going to happen if your expenses go up in 5 years, in 10 years, in 20 years, as they almost certainly will. Now, there are a number of different complicating factors that I'm just going to mention. The first complicating factor is your required minimum distribution. So at 70.5, the IRS previously had required that you start taking money out of qualified accounts. Because of the Secure Act that was just recently passed at the end of 2019, that age has now been changed to 72. But whether you're 70.5 already, or whether or not you're waiting until 72, the Internal Revenue Service will not allow you to continue to keep money in a retirement account indefinitely. They're going to force you to start pulling some money out and settling up some of that debt. That's going to affect planning as well, because if you're counting on a particular balance, let's say you're 65 years old and you've got a particular balance in your account, you're going to have to realize that there is going to be an additional drag on that potentially if the required minimum distribution isn't already being met by your plans of withdrawing money from your account. Now, the second issue that I've touched on in a couple of these has been legacy planning. There's a difference between a retirement vehicle and a vehicle that is optimal for legacy planning or for beneficiary or inheritance purposes. And they often don't do the same things. The same vehicles don't work as well doing both things. So an IRA might be really good for retirement planning, but it's not really good for legacy planning. Finally, these ideas are only as good as the assumptions. So there's going to be assumptions about what rate of interest you're going to get, what rate of return, what yield, what the dividend's going to be on a particular stock. Maybe there's going to be assumptions that are baked in. We're going to say your expense projections are going to factor into this, what you think that your inflation rate might be or cost of living increases, and all of those things are going to kind of form the totality of your best guess in terms of what you're going to need to use in retirement. In addition to that, there are going to be personal factors like what you want your retirement to be like. Do you want to be simply in your house? Do you want to be traveling the world? And those are going to require different investment commitments, different funding levels. So I get into some of those in other places, but for here, I'm going to end it. If you found something of use in this video, I ask you to please like the video, subscribe to the channel, please click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video.